Very pleased to welcome to Forward Guidance for the first time Michael Harris, president at Quest Partners, a quantitative driven investment fund. Mike, great to see you. Tell us a little bit about yourself, your background, and Quest Partners. What type of quantitative investor are you? What type of quantitative investor is Quest Partners?
Thanks again for having me on. I'll start by just telling you a little bit about my background. I think it's unique because I've been in the quantitative hedge fund space literally since the beginning of my career over 25 years ago. I started at Morgan Stanley as an allocator to quant funds, CTAs, and macro funds. I kind of caught the trading bug, if you will, when I was doing due diligence on a lot of portfolio managers sitting on desks. Wanted to kind of get a taste for trading the markets myself. Became a sell side, futures, options, and currencies broker. Covered a ton of CTAs and quant managers as well as discretionary macro. And then realized that you could train a monkey to do what I did back in the old days, kind of on two phones, just parroting order flow back and forth between buy side trading desks and the floor. In many cases, I was fascinated by the buy side and wanted to kind of understand, how are they coming up with these trading decisions? Were they using data and models, obviously the quant approach, or was it just a bunch of smart people sitting in a room coming up with an investment thesis and acting on it? So I made the transition over to Campbell and Company, which is one of the oldest CTAs, founded back in the early 70s. I spent 12 years on the execution side there, and then became president of the firm, and did that for about 8 years, kind of running that large multi-billion-dollar CTA. Um, Pseudo retired at the end of 2019. Had a bit of a sit out, due to non-compete reasons. Ran a multifamily office, which was incredible to put my allocator hat back on and be able to help ultra high net worth families invest not only in traditional stocks and bonds, but to really help them build a portfolio to kind of quote unquote keep them rich for the long term, using tons of alternatives, private equity and debt, real estate, hedge fund strategies. So that was a lot of fun. And then 2 years ago, Quest's president was retiring, and I got the phone call. I had met Nagal at a number of industry conferences over the years. I think even probably spoke with him, our founder, and was excited when they extended me the opportunity to come and be the president of Quest. And so now I've been there for about 2 years. Quest is a $2.5 billion short-term quantitative hedge fund. Within the CTA universe, we fall into the realm of what are called short-term traders, which is typically people that trade, faster than, let's say, 2 weeks. Our average holding period is about 6 to 9 days. But as you can imagine, we have some trades that happen intraday, which would be our fastest, and then probably our slowest are about 40 days or so. So we try to capture momentum in the markets in a number of different ways. And I think really one of the things that Quest is known for is our focus on delivering positive skew or convexity in our return profile. When volatility picks up in the markets as a result of, who knows, a surprise economic release, a geopolitical conflict, something that the market wasn't expecting or pricing in, positively skewed strategies like ours tend to do very well. Markets react. They break out of recent trading ranges. Our models pick up on that. We're able to kind of load into those trades very quickly. And the profits that we make during those times of turmoil, we kind of jokingly say we're putting the hedge back in hedge funds.
CTA's commodity trading advisor. That can mean a lot of different things, but I think of it a core part of that, not strategy, but that world is trend following. So oil is at $70, it goes to $71, then it goes to $72. Your models pick it up, they start buying, it goes to $73, and things, something that went from 70 to 72, it's more likely to go to 72 than 74 than 70 statistically. In other words, if it's going up, you buy it, and that the back tests for those very simple models are quite impressive. So how much of your current strategy, your being Quest, it revolves around some form of trend following. Oh, natural gas went from $2 to $2.10. It might go to $2.20.
Let me unpack a couple of things that you just referenced. First, the term CTA or commodity trading advisor is in itself a bit dated. In the late 60s, early 70s, when the industry really started, the only futures contracts that were available to trade in liquid were commodities. So the regulatory designation that we all had to take back then was that we were commodity trading advisors. Obviously, in the 1980s, financial futures were launched. And now, when you think of a typical CTA portfolio, unless someone is asset class specific, it's much more diversified. So, you're trading equity index futures around the world, you're trading fixed income futures, either currency futures or OTC FX. And then, obviously, commodities continues to be the fourth asset class in that mix. And oftentimes, one of the most diversifying, because you can imagine what's driving the price of natural gas is probably a little different than what's driving, let's say, global interest rate policy, which is having an impact on FX, fixed income, and the equity markets. From a CTA perspective, the earliest form of systematic trading, you're right, is trend following. There are lots and lots of ways to implement trend following. You can do it on different types of markets. Some of our peers and competitors in recent years have made headlines by expanding their portfolio into new markets, going into interest rate swaps and credit default swaps and exotic commodities and non-deliverable, emerging market FX, in order to try to look for trends in non-traditional markets. But I think probably, the biggest differentiator when you're doing trend following is your time horizon or your look back. So most trend followers, tend to look for medium to long-term trends. So a medium-term trend might be a trend over, let's say, a 1 to 3 month period. And a long-term trend maybe, say, 3 months out to a year, in some cases beyond a year. But as I was saying before, where I think we're unique is that we are a short-term trader. So we're looking for trends just for, in some cases, a handful of days. I'll give you an example. So think about the gold market this year. Gold had been in a very tight trading range for the first couple of months of the year, really not going anywhere. Um, Probably in large part because there's been this sense of monetary policy anxiety. People really don't know kind of when the Fed was going to act, and in the direction, if you will, of interest rates, which is a big driver, obviously, of people who want to hold gold. Typically speaking, when interest rates are coming off, and interestingly enough, the People's Bank of China decided that they were going to make a change in their overall allocation and acquire more gold. They came into the market in March, and that sleepy kind of gold market all of a sudden had this breakout from the recent trading range to the upside. Our models picked up on that initial move. We were able to kind of load into a long position in gold, hold it for a number of days, capture some nice gains, and then we have, take profits, and we call time-based exits, where effectively from an alpha perspective, that alpha is decaying with every day that we hold the position. So at some point, the model basically says, hey, whatever created that initial break to the upside or short-term momentum move, that has already effectively happened. And there, the market has found a new trading range. So it's time for us to take our profits and move on. If you compare that to the larger CTA industry, who does, once again, more medium to long term trend following, it's a very different kind of trading profile. And you described it well, in that a longer term trend follower, number one, has to wait, in some cases weeks or months, to see a trend developing. They need to see a good enough move to detect that a long term trend is in play. They then typically will build their position kind of over days or weeks. And so the example you gave, where natural gas is trading higher, they buy 5%, then it continues to go up, they buy another 5%. And at some point, if the trend continues for long enough, they get to 100% long in that market. And then only when the trend reverses and starts heading the other way do they start hitting their trailing stops, which is then taking them out, or hopefully collecting some profits on that longer term trend. I think that when you think about using these types of managers in a portfolio, oftentimes people will blend us as a short term trader with some of those longer term trend followers. The idea being that if there's a very short, quick, or abrupt expansion in volatility due to some sort of crisis. Think about COVID as an example, where on March 11th, 2020, the entire world realizes we're going into lockdown and markets cavitate lower. As you can imagine, our systems, were able to pick up on that, get short in global equities and long flight to quality assets, and make some nice gains that it helps, protect our investor base. But the longer term trend followers, it takes a much bigger move over more time for them to pick up on it. So that's probably not the type of manager in that very abrupt and fast scenario that you want. On the flip side, when you look at a prolonged crisis, I mean, think of the global financial crisis that dragged on for 2 to 3 years in some cases. There were very, very long and robust trends, and those longer term managers were able to capture many of those movements. So, at the end of the day, it's a little bit like a baseball team. You have different players who play different positions in your portfolio to help you in different points of market stress.
What your strategy really shines is when you have large amounts of volatility in a short period of time. I can't think of a more apt example than March 2020. What is the opposite? Because all strategies have environments where they do great, environments where they do less well. What are the strategies where being a short-term trend follower is not a good environment, or it's just a lot tougher?
I'll bring up two examples. So the first one is, we are a long volatility strategy. So when there's not a lot of volatility in the markets, markets aren't breaking out of their recent ranges, and we quite frankly don't have a lot of opportunities to trade and hopefully make profits. So if you think about it, let's look at the last 3 years as an example. We've talked a little bit about 2020, but if we focus on 2022, that was a great environment for both being a short-term trader and being a long-term trend follower. You had obviously the outbreak of the conflict between Russia and Ukraine, which created a lot of volatility in March of 2022. You also, in the second half of the year, had kind of these inflationary pressures that were, kind of feeding through the market on the back of the pandemic and some of the supply chain, issues and delays there. So you had both an initial spike in vol when Putin crossed the border into the Ukraine, and we all thought it would be a 2 week conflict, and then obviously we started to realize this was going to be a much bigger issue, particularly for Europe. And so you had that initial big moves in March, which we were able to capture, and then this in the later part of the year, as markets continued to trend and in some cases break out of ranges, we were able to do well. Our peers were able to do well. But if you look at 2023, there was almost no volatility. Volatility, whether you look at the VIX and equities or other volatility indices across asset classes, there was vol compression, meaning it would just basically trended lower for the vast majority of 2023. Actually, really only had two mini spikes in vol last year. One was in March with the regional banking crisis with SVB and Signature and Credit Suisse. And then in October, you had the initial outbreak of the conflict between Israel and Hamas, which also created obviously an initial spike in vol. This is the downside sometimes to being a faster trader, is that, if let's take March as an example, if you remember that week in March 2023, when some of the regional banks started to have trouble and SVB and Signature went down, people were lining up on the West Coast outside banks trying to get their money out. Credit Suisse obviously, was struggling. And then we go into that weekend. Our models had flipped from being long risky assets to going significantly short, stocks and energies. And basically, two important, basically government intervention items happened over that weekend. Number one, the Swiss government effectively pushed Credit Suisse into UBS's arms. kind of dealing with that global bank issue. And then on Sunday, Janet Yellen came out from the U.S. Treasury and said they were going to effectively backstop any regional banks that had issues. And so Monday we went right back to the highs. And having just gotten short in that first couple of big day moves the week prior, we got stopped out of all of those trades and recorded some losses. So you have to, once again, not all strategies work at all times. And I think the important thing that or difficult thing for allocators to think about is how do I build a portfolio so that I have different types of strategies to protect me in different types of environments. We know that predominance of most of the portfolio, obviously, when you think about skew, the vast majority of strategies are negatively skewed. Long equities and the vast majority of other traditional hedge fund strategies that are trading stocks, we have some beta. They tend to kind of take the stairs up and the elevator down in a crisis, whereas a positively skewed strategy like ours, if we're kind of grinding along when there's not volatility, and then when an event happens and vol spikes, those opportunities present themselves for our models to trade them. And oftentimes that's when we're able to, as I said, record profits in a moment where those long stock positions and other quote unquote alternatives may be selling off in our investors' portfolios.
Hello, everyone. Permissionless 3 is coming to Salt Lake City on October 9th. The event for crypto natives is heading west, and we are bringing the biggest names in crypto together for an insane, can't-miss event. Hear from more than 200 industry titans, including Balaji, Mike Novogratz, and Dan Tapiero. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups and L2s, institutional adoption, and of course the November election that will be right around the corner. We couldn't be more excited about this event. Get your ticket today and make sure I get some bragging rights by using my code FG10 to get 10% off. That's FG10. Stands for Forward Guidance. I want to see you there. Do it. It's going to be at one of the most beautiful places in the United States, and everyone's going to be there. Van Spencer's going to be there. Jim Bianco's going to be there. Jan Van Eck's going to be there. So what are you waiting for? Get your tickets now by clicking the link in the description and use code FG10. Back to the episode.
Right. So the algorithms really are running the show. And if a company has a great earnings call, phenomenal results, but the CEO doesn't mention AI, that stock might not perform as well as a company that had a mediocre quarter, but the CEO is talking all about AI. But you do not trade individual stocks. You only trade futures, which are futures on interest rates and futures on equities as well as commodities. But you're just futures, right?
No, actually, historically, we were futures and FX. And about 3 years ago, we started to add single stocks into the portfolio in a small way. I think it's something that the CTA industry has embraced for many years, is that the same systematic kind of quantitative approach that we take to trading futures and currencies can be applied to individual equities. I think it's really has been part of kind of the call it growth and diversification of our industry. And so we're excited about kind of what we're doing there. It's about 5% of our portfolio, and it's an equity market neutral approach. So obviously, equal amount of longs and shorts obviously protect us from larger kind of beta moves in the market. And really, what we're doing is looking for short-term momentum plays. As let's say people are rushing out of large caps and moving into small caps, or you're seeing a rotation across other kind of equity style factors. There are momentum, and in many cases it's multi-day. So you can imagine we can deliver that same positive skew that we do in the futures markets in equities. And it actually, I think it's great that we're talking about this, because it kind of brings up, I think, what's a pretty significant risk in the markets right now, which is that there are a lot of people who are trading quantitative equity stat arb right now. You think about the multi-strat hedge funds, the quote unquote pod shops. Back in 2018, there were about, I don't know, call it 25 to 27 of those funds, and they were managing about 150 billion in assets. Fast forward to today, it's getting close to 60 multi-strats and their assets are north of 370 billion. So the industry has more than doubled over the last, call it, 5 to 6 years. And we know just from our friends who work there and from interviewing researchers and portfolio managers who have come from or are at the multi-strats that all of them are allocating a significant amount of capital to equity stat arb. So we're concerned that space may be getting crowded, and that hey, going back to August of 2007, and there have been multiple iterations of these mini quant kind of crashes where there's just too much crowding, and then as people start to lose money for whatever the reason, they're very quick to delever their portfolios. The joke in the multi-strat space is, I'm going to allocate capital to a PM or a pod. If you go down 2.5, though, 2.5%, I'm going to cut your allocation in half. If you go down 5%, I'm going to show you the door. And so using that tight kind of risk management framework on these allocations, you can imagine if a trade is crowded, oftentimes they're also, think about statistical arbitrage, they're using leverage to effectively lever up these small arbitrage opportunities in order to make profits that investors would be willing to pay fees for. And so crowded trade that's levered, and then they start to lose money, and you see that kind of systematic deleveraging happening, tends to create some big moves. So we've recently created a model we call tactical anti-crowding that looks for these kind of crowded moments in statistical arbitrage. And then it unwinds, our model effectively takes the opposing position. So it goes long the traditional shorts, it goes short the longs, and it creates a basket approach to being short statistical arbitrage. And obviously we launched it last year. We haven't seen one of these unwinds yet, but the last big one just happened in 2020 when the pandemic hit. And I think a lot of investors really, unless they had direct exposure, missed it because they were so focused on obviously COVID and their own personal health and safety. But if you had an allocation, a lot of these, stat arb type strategies, that when the markets sold off, the statistical correlation between a lot of names, sectors, baskets, and factors broke down, and we saw deleveraging kind of happening in that space. And so we don't know if that's going to happen, today, tomorrow, next month, or next year. But we wanted to have something in the portfolio once again that could help hedge that risk for our clients.
That is so interesting. I'll ask you about multi-strat in just a moment, but on the topic of equity arb, that there's equity statistical arbitrage, that already is kind of giving me a funny feeling because maybe I'm just a stickler on the word, but arbitrage is, I think, a somewhat strict definition of like you buy gold in New York for $1,900 and you can sell it in London for $1,920. Even the phrase merger arbitrage is just quite a successful hedge fund strategy about company A is going to acquire company B, but company B is trading at a discount to the price to the price. So you go long company B, and if it's a stock deal, you go short company A. Even that is not arbitrage. It's arbitrage if the deal goes through, but it's really merger speculation. It's a speculation that the deal goes through, which most deals go through. But the term equity statistical arbitrage, that would, if it's a pure arbitrage, you're buying Citi for $50 and you're selling it for 52 at the same time, which obviously that's impossible. But what are they doing that is not a pure arbitrage, but it's close to an arbitrage, and they call it an arbitrage, and they've been quite successful with it, with a lot of leverage, exploiting these correlations. Could you just explain in simple terms what is this equity statistical arbitrage and why you may have some concerns about the risk it poses to the system?
Sure. Well, I mean, first off, stat arb, which is the nickname for statistical arbitrage, has been around for many years. And in many cases, it can be a very profitable strategy. What we have seen historically is that there are statistical relationships in the equity markets. And so if you look at names that may have they're in the same sector or subsector, they have very similar business lines, typically speaking, they're going to be very correlated. And so what these models do, obviously, and they're doing it obviously across 1,000 stocks, and using automation and technology, they're just looking for any sort of a blip on the radar where two names that almost always trade in lockstep, maybe there's a rumor that one of the companies is going to be taken over. And so investors start buying that stock as opposed to its kind of partner or pair. And so all of a sudden, that stock, let's say goes up 2% on the day, and all of the other stocks in its industry are only up 1%. We'll say that the S&P is up 1% on the day. And so the general market is just kind of dragging those stocks up with it. Immediately, all of these computer models around the world are going to say, hey, something is happening. This stock is up more than its group or its basket, and it shouldn't be. And so typically what the models will do very quickly when it identifies this potential arbitrage opportunity, it will put a short position on that stock that's up 2%, and then it will go long either the most related or correlated name that's only up 1%, or potentially it'll go long a couple of stocks in its basket. And then what you're waiting for is for that, basically that relationship or that spread to close. So then maybe an hour later, the CFO comes out and says, hey, I know there are rumors in the marketplace that we're going to be acquired, but that's just, categorically false. And immediately, right, that stock that's up 2%, those people that had jumped into it start selling it, and it goes right back down to maybe where the rest of the market is. Or potentially that stock went up because maybe they had an earnings call and they said something. Who knows? Maybe they mentioned the word AI, or they said something about their business and their industry that got people excited and basically started buying it. And now the rest of the market kind of catches up and says, well, if Google's up on that, maybe Microsoft will go up on that too. So I'm going to go buy related names. So in some cases, maybe that stock doesn't come back to the basket. Maybe the basket rises to the name. Either way, you've positioned yourself to effectively be able to kind of capture the closing of that statistical relationship. And so the risk that I was referring to is that from time to time, like these things work in what I would call normal markets, but from time to time, things happen obviously in the world that are not normal. And oftentimes, when the not normal happens, let's say one of the Magnificent Seven, completely blows an earnings call and the stock is down a huge amount, and then people start making other decisions in their portfolio, potentially delevering. Now those very tight, statistical relationships or correlations start breaking down, and as they break down, the spread is not, closing, it's widening. So those managers are now losing a lot of money on those trades, and as they take them off and delever the book, then what it's doing is, almost think of it as dominoes. It's kind of knocking into other managers who are losing money. They're delevering. And so as the dominoes fall, unfortunately, it just gets worse and worse.
Thank you. And I can totally understand if everyone is long risk, if everyone is 5 times levered the NASDAQ, and then the NASDAQ goes down more than 20%, or even goes down a little bit, and there's a cascade of selling that forces more selling, and there's a fire sale into a falling market on leverage, it's a disaster. I understand that. But when talk about the trade, so we can obviously, we're just making these examples up, but whether you're talking about Bank of America goes up more than JP Morgan, so that people are short Bank of America and long JP Morgan, or we can make it Nvidia and Apple. I mean, you take your pick, but company A, company B, everyone's crowded into the same position. But how does that cause system wide risk if it's they're not long the market in general, they're not long everything, they're just long the spread between Nvidia and Apple for 2 hours? Like, how does that go from a very idiosyncratic thing to a wider cascade that you're concerned about?
It's possible that a delevering of people that are trading statistical arbitrage could lead to a market sell-off, just because basically people are seeing large movements that are unexpected in the market. So maybe somebody that's not even trading equity market neutral, long and short the market, maybe somebody that's just long the market is seeing a real pickup in volatility. They're seeing relationships that they know they feel confident in breaking down. And so it creates fear, right? It creates anxiety. The two most powerful emotions in trading, right, are fear and greed. And when fear sets in and people think, wow, we've had a good year, it's actually one of the reasons that I think the market's a little on edge right now, is that we've had a great year. from a long equity perspective, and people in some cases think maybe it's a little long in the tooth, and they need to think about taking some profits. If something happens, a headline because of the geopolitical conflict happening in the Middle East, that sends the market lower, that could be a trigger to have all of these kind of nervous investors to kind of then rush for the door. And the way you have to think about that is, imagine 100 elephants trying to run through one door, right? The first couple make it through the door, but then it just becomes a terrible mess, by elephant number 4 or 5, and extrapolate all the way through. So I think that oftentimes there could be something happening specific to a hedge fund trading strategy like statistical arbitrage, and that because you're seeing deleveraging, you're seeing kind of unwinds happen, and all of these spreads and correlations are breaking down. It's creating a lot of noise in the marketplace, and I think once again there's the potential for that to spook the broader market, which then sometimes just triggers either profit taking or deleveraging. And when that happens, obviously, it is like 100 elephants running for a door, as the markets, come off. And my sense is that this is a systemic risk that the regulators are aware of. I think that it's something that they've looked into. They've talked to the industry, but it's also something, it's a risk that's been around for some time. I mean, statistical arbitrage trading has been happening, since the 80s and 90s. We've had a number of these quant crashes or unwinds. And so I think it's something just to be focused on, because there's more and more investment dollars going into that space. And obviously, as technology improves and gets better and there's more data available, people are able to trade these strategies faster and more efficiently.
Interesting. Tell us about, what do you think is behind the rise of the multi-strategy hedge funds? Why are they so popular? Have they, is it because they performed well? And if so, why have they performed so well? What is it about multi-strategy hedge funds? And do you think it's a little overhyped right now?
Well, listen, multi-strats have been around for a long time, and they have performed. Some of the biggest ones, names like Millennium and Citadel, have done very well historically. They've got a great risk-adjusted return, even with some of the highest fees in the hedge fund industry. I think that when you think about it, I go back to me explaining how, as an allocator, you've got to put together all of these different, strategies to create a solid portfolio. Well, having somebody at one of the world's largest hedge funds who has been doing this for 30, 40 years, has picked some of the best portfolio managers and teams, and is able to assemble a portfolio that then the investor, all they have to do is write a check and sign a DDoc, is a lot easier than having to go out there and try to do it on your own. And I think that because they've grown to this magnitude, they've also gone out, and they vacuumed up a lot of the talent on the street. So, when I started in this business, 2 or 3 folks who, let's say, worked at Goldman Sachs together, could circle up $5 to $10 million of friends and family capital and go launch a hedge fund, and hopefully kind of grow it over time. You don't hear about that anymore. There really aren't that many kind of brand new from nothing launches in our space. In large part, most of the new funds that come about are usually spin-offs of the multi-strat. So, one that's been in the media, Bobby Jane from Millennium, just did one of the largest spin-outs, that the industry has ever seen. Multiple billions, where he said, "Hey, I want to go out and run my own fund and not be under the Millennium umbrella." So they said, "Okay, great. We're going to help you get set up. We're going to basically give you seed capital. We're going to continue to allocate to you outside of, the Millennium umbrella, and then you can go out and raise additional investor capital." And so, it's becoming harder and harder for kind of the little guys, if you will, to try to break into the space, because let's face it, the amount of talent, data, and infrastructure that you need in order to run a real institutional quality, hedge fund or alternative investment company that institutional investors will embrace, that you'll pass due diligence, that they'll want to allocate capital to you, that bar just keeps getting higher and higher. I remember Citibank put out a piece years ago, saying that, you had to have at least 500 million under management in order to kind of start to tick the boxes and have enough revenue to kind of pay for all the things that you would need in order to pass the test. I haven't seen that study updated, but I have to think that number is getting closer to 750 or a billion. And once again, some of these multi-strat spinouts and launches are showing that the bigger getting bigger. So listen, at the end of the day, like anything, it's a dog eat dog world on Wall Street, and multi-strats do, because they're expensive to run, charge some of the highest fees out there. You're usually a 2 and 20, and then some sort of a pass-through structure, meaning additional expenses like data and people and tech are passed through to the investor. That can be as high as 7 to 8% in some cases. And so you really have to be generating some strong returns for people to be willing to pay those fees. And I think, once again, some of those kind of cornerstone funds that have been around for years continue to generate, very impressive numbers. And that's why they're some of the largest in the world. There will probably be some of these multi-strats that have launched in the last 5 to 10 years that, don't perform as well. The capital, walks out the door, and then obviously the expenses are still there. So, we may see some of those funds closing in the years to come. If you look just at performance across the space this year, there's a pretty big gap between the top performers and the bottom decile, if you will, and investors won't put up with that for long.
I guess it's just that when you have so many different strategies, one strategy is working, you get to allocate more towards that. One strategy is not working, you get to pull it away, and that is a way to generate returns.
Well, I mean, it goes to what we were discussing earlier, and it's the reason that most of these strategies are negatively skewed, right? Because when you think about it, they're almost doing trend following on top of portfolio managers. When a pod or a PM is making money, chances are they're going to allocate more capital to that team or person. And that, once again, think about that risk management protocol we talked about: down 2.5, I cut you in half; down 5, I show you the door. That means someone who's losing money is going to have money pulled from them. And so effectively what they're doing is chasing higher Sharpe ratios at the PM level in an effort to boost their Sharpe ratio at the fund level. And what we've seen is that there's a very high degree of correlation between the level of Sharpe that you have and your negative skew. Vis-a-vis, that works like stat arb, right? That works until it doesn't, until there's some event, there's some macro shock that happens where all of a sudden, markets turn over. As I said, negatively skewed strategies take the stairs up and the elevator down. When they take the elevator down, I mean, it's 50 stories, like the cable broke, straight down. And, as people are unwinding trades, as they're, getting in and out of things, usually getting out, that creates momentum. And that's the momentum that Quest, that our strategy basically lives off of. So once again, I'm not hoping for that to happen, but I am a realist, and I know that historically, looking back over time, markets don't always go up. There are times where things happen, wars happen, people, the economy in some cases goes from good to bad, and as a result, it creates momentum in markets that we can trade and hopefully provide that hedge to our investors.
Right. So the Sharpe ratio is how much reward you get for a unit of risk. So a higher the Sharpe ratio means more reward for risk. But the higher the Sharpe ratio, i.e., the more quantitatively attractive it is to the quants, the more negative skew it has, meaning the greater the tail risk is, meaning 98% of the time you're going to make a lot of money in steady fashion, but that 2% you're just going to go bankrupt. That's what you mean.
Sharpe ratio is effectively taking the return of the strategy, backing out or subtracting the risk-free rate, what you could get to just put your money, let's say, in treasuries and not take risk in the markets, and then dividing it by the volatility of the strategy, right, which is kind of a proxy for risk. So let's use a simple example. If your strategy is making 15% per year, and we're going to subtract 5% because you can get 5% or close to it in a T-bill right now. So that means that, once we back that out, your strategy is making about 10%, right? We'll kind of call that it's like your alpha above what you could get for doing nothing. And then if your volatility of the strategy is about 10% per year, then you're dividing 10% by 10%. And that's the Sharpe ratio of that strategy would be 1.0, which is a very good Sharpe ratio. In some cases, though, the strategies that the multi-strats are allocating to, they're looking for Sharpe ratios in some cases north of 3. And so you're getting a lot more return by taking less risk. The caveat to that is that that's assuming that all of those relationships and markets, stay very, very closely correlated. And that was my point, that when they break down, now risk and volatility elevates in the marketplace, and oftentimes those strategies, lose money. And so in a shock, in a macro event where markets are moving in all different directions, your Sharpe ratio that you felt really good about, and you put a lot of money into that trading strategy, turns around very, very quickly as your profitability goes away and your risk or your volatility goes up pretty dramatically.
What have you made of the explosion of private investments, both private equity and private debt? I mean, you look at some of these endowments, and 30%, 40% of their portfolio is invested in private equity, which is huge.
Yeah, it's a great point. I mean, over the last 5 to 10 years, there's been an absolute explosion in private market investing. And listen, up until recently, I think the returns were fantastic. The momentum that's generated by all the money coming into the space and valuations getting bid up, I'm sure helped that to a certain extent. I guess my greatest concern is really liquidity, because as we know, private market investing traditionally is a 10-year lockup. Obviously they're calling capital at different times, and in some cases when they exit a particular investment, you're getting capital back. So it's not 100% locked up, but oftentimes you're not getting money back when you need liquidity in the portfolio. And unlike an investment in a macro fund, or even just going out and buying a portfolio of stocks, you can get liquidity in many cases anywhere from intraday out to 3 months, which is a pretty short time horizon to redeem funds in my space. Usually the redemption cycle is monthly, so it's plenty of time if somebody needs to get liquidity. That's not easy to do in private market investing. And there have been a couple of recent examples over the last few years where U.S. pension funds have had to exit a chunk of their private equity, and in many cases they were taking huge haircuts. We're talking 20 to 30% reductions in the value of their investment, for somebody in the secondary market to kind of take on that position and give them an exit door. So I just worry that with the euphoria and the returns that people were chasing in that space, I think it's a great asset class. I just think that maybe people are a little overextended, and that could create an issue. The other problem with private markets is that people have the fallacy that they don't go down. When public markets go down, you don't get a private equity statement for 3 to 6 months. So there's a significant lag, and as a result of that, you don't see it like you see with CNBC on in every office. The market's down 2%, the market's down 4%. No one is reporting those types of numbers on their private holdings, and so it fools people into thinking that the value of their portfolio is stable and not declining. And so I think that's another real risk, that if there is just a downturn in the economy, that we see valuations going down, the public markets go lower. Obviously, the value of private companies are going to go lower as well, and people then don't start to see those eye-popping returns from some of the large private equity and debt managers. That could be a challenge, and could be potentially a regime shift in the future. But when I talk to investors, I just try to make sure that they're going into private market investing kind of eyes wide open, understanding kind of both the benefits as well as some of the risks.
And private investments definitely have their place, and they have historically performed well. I'm seeing some news articles, and I'm sure you're probably more privy to this than I am, of private investments, people wanting to put them in, retail hands, and in some cases in an ETF. Is that nuts? I mean, putting like a private credit instrument, a private loan to a company that's not going to be paid off in 6 years into an ETF, and unlike a high yield bond, these things don't trade.
Well, I mean, obviously, I've read the same articles that you have, that some of the biggest players in the world are looking for ways to give more liquid ways to get either PE or private debt type exposure in liquid, whether it's 40 Act or ETFs or interval funds. ETFs definitely seem to be the big area of focus right now. Some of the articles that I'm reading. I think the regulators are going to look at these products as they're being stood up and launched with great scrutiny, because to your point, there are a lot of different ways to synthetically try to get that exposure, and hopefully the ways that are being embraced are ways where if there is a run on the bank and people want to get liquidity from those products, somebody's not left holding the bag. Um, and I think it will be incumbent on the individual investor and their financial advisor or representative to kind of help them explore, how am I getting this exposure? Because I've seen some structures where folks are, buying something thinking they're actually getting the returns of a private equity fund. And maybe they're actually just investing in a private equity company. So you're getting the revenue of the private equity company, but you're not getting obviously the returns of the funds. Hopefully, those two things are correlated. But as we talked a lot about on this interview, sometimes correlations break down. I actually I know one firm that's got an interesting product where they're just basically using quantitative methods, replicating what private equity does when they go and buy private companies, and they're using the same metrics and models to then do that in the public markets. So they're creating kind of a replication, if you will, of what a private equity strategy would look like in public markets. And obviously, the stocks that they're buying and selling are traded and liquid, and therefore, liquidity is no problem for that type of private equity strategy in an ETF. But I know that there's a lot of people out there trying to build different types of mousetraps, and with that there will be risk. And as I said, I just hope that investors are going into it eyes wide open, and that hopefully the regulators are also going to focus in on this area, because at the end of the day, we don't want. It's a great diversifying exposure if you can add it to a portfolio, but obviously we want to do it for the investment landscape and world in a safe way.
Right. And that is an interesting strategy of taking a private equity approach to public markets. Of course, there are elements of private equity that you cannot bring, that, you're not going to have a controlling interest. You're not going to be able to make management changes. You're not going to be able to, pay a giant dividend to yourself. You probably aren't going to be able to use the same leverage. So it's difficult. Michael, I want to close on a topic by tying together a few topics we've talked about. You talked about how your strategy at Quest, and I suppose we were talking about the flagship fund, AQO, Alpha Quest Original, is exposed to volatility. So when I think of that, of strategies that benefit from volatility, classic example is a put option on the stock market. It benefits from the stock market going down. It benefits from realized volatility. If it realizes, if they bought it at the implied volatility of 20 and it realizes 30, they make money from that. And then they make money from the implied volatility, because the implied volatility is going to go up. Do you invest in options at Quest? And if not, how do you benefit from volatility?
So we don't invest in options. It's a question that we get quite a bit when we're described as a long volatility strategy. I mean, at the very core, once again, pull up a chart of the VIX, right? When things happen, right? As in, we've talked about a lot of different things, right? A global pandemic, a new geopolitical conflict or war starting, inflation, hitting the global economy. All of these things that are unexpected create volatility, right? So something happens, the market doesn't have priced in, and if it's of a magnitude where people are adjusting their positions, you're going to see volatility spike. When that volatility spikes, what are markets doing? Markets are breaking out of recent ranges. So if they're risky assets like stocks, chances are they're selling off. If they're flight to quality asset or perceived safety assets, like we talked about fixed income in some cases, gold, certain currencies like the Swiss franc, the Japanese yen, sometimes the US dollar, depending on where the crisis is. Investors are selling risky assets like stocks. They're buying those safety assets like bonds, gold, and certain currencies. And so as volatility expands, markets are moving, and that's amazing environment where our models are able to then detect those movements, get us into those trades very quickly, and hopefully have some significant gains that we can monetize over a week or two. And when you think about it from a portfolio standpoint, those are the environments when many of our investors are losing money. And so we're providing once again that hedge in their portfolio. Now, you know, we haven't talked about it, but speaking of option strategies, right? I mean, a lot of portfolio managers will use options to effectively provide that hedge in their portfolio, right? It's doesn't take a genius to think that if you buy a bunch of put options on the market, that if the market goes down, your holdings will lose money, but those put options will make money and create a hedge. There are plenty of people that do option overlays, or they buy volatility. You can do that just by investing in buying the VIX futures contract as an example, so that if it goes up, you would be profitable. There used to be hedge fund strategies that were called dedicated short bias, where managers would go out and find kind of what they thought were the worst names, and they would short them in the hopes that if there was they would make money in the relative value sense of these stocks are not going to do as well. But more importantly, in a market downturn, they would be very profitable from having all of these shorts. There are tail risk protection funds that buy way out of the money options in the hopes that there will be a big payoff or convexity if something bad happens. The challenge with a lot of particularly option strategies is what we call the bleed, right? So you're paying premium to own that protection year after year. Think of it as you bought a beach house, and you have to get flood insurance, right? Now, if there was a hurricane last year, you're going to rush out to buy that flood insurance, and you're not going to care what you pay for it because you want to have that protection. But imagine that it's been 10 years since the last hurricane, and you get your 11th year, you get the bill for your protection that you haven't used in 10 years. Uh, Investors from time to time just think, hey, do I need this? Is this, do I self-insure instead of, bleeding money every year by buying this protection? At this point, I could have if I add up all my premium, I could have rebuilt the house myself. And the same thing happens when people think about portfolio insurance. And so I think it's a long-winded way of saying that people look at our strategy basically as very similar to being an option kind of protection strategy. But because we have a positive risk adjusted rate of return or Sharpe ratio, we're making money for you as opposed to charging you that premium. And so will we be, like in some cases, options, 100%, certainty that we're going to protect you in every crisis and environment? No, it's impossible for us to be able to do that. But we're there the vast majority of the time. And I think that, when investors look at our track record, that's typically what they do is they remember the crisis moments where the rest of their portfolio suffered. They go right to that month or that quarter in that particular year, and they look at how we, performed to see whether or not we could be that kind of cheap hedge, if you will.
Michael, as we reach a close, anything in current market stocks? You said maybe stocks, due for a little bit of correction. My words, not yours. But anything, all the markets, commodities, currencies, interest rates, and stocks. Anything where you kind of have a directional view or a hunch, or something interesting you're seeing based on your trading as well as your models.
As we look at macro, I've been doing a lot of traveling the last couple of months and meeting with our investors and seeing prospective investors. And I'd say, I always like to take a little survey at the end of the meeting. Do you think we're going to see more volatility in the second half of the year or less? And I mean, I don't think I had a single person that thought there would be less volatility. You have an equity market that's run quite a bit. You have a tremendous amount of concentration, obviously, in the equity market. Something like the top 30 companies in the S&P 500 are 53% of the overall market. Like that's not healthy. The largest five, Microsoft, Apple, Amazon, Nvidia, and Meta, make up about 25% of the S&P 500. We haven't seen these levels of concentration since the dot-com bubble. Now, there's one important differentiation, which is that Nvidia and these companies are making money, unlike some of those dot-com companies that were in the red. But it just doesn't feel healthy that there's only a handful of names kind of driving this rally. Geopolitics. I mean, we've got two global, conflicts happening. Obviously, who thought the Ukraine-Russia war would still be going on? And just in recent days, we've seen an escalation in kind of the conflict between, we'll call it Israel and Iran, because Israel is obviously fighting, everybody from Hamas to Hezbollah to the Houthis in Yemen, all obviously are funded and backed by Iran. And now that you're starting to see, some of these, assassinations happening on Iran's soil, the temperature is definitely up there. I think that you can't rule out a third geopolitical conflict in that, if China wants to make a move towards Taiwan in the South China Sea, I am not their military forecaster, but the U.S. is already involved in two conflicts, and there's an election obviously happening in November. So if you wanted to be more aggressive with your agenda, now might be the time to flex some muscle. We've seen some conflicts with China and the Philippines where it almost feels like they're doing a dress rehearsal for Taiwan. Obviously, a third geopolitical conflict would be something that would generate a lot of volatility. So, from a monetary policy standpoint, I think the Fed did a really nice job yesterday of communicating that they're not ready to cut rates, obviously, in July. But September looks pretty good. They're going to be data dependent. Remember, between now and the September meeting, we have two more jobs numbers, we have two more inflation prints. And so it's really interesting. We will get both of those right before Powell's speech at the infamous Jackson Hole, which there have been obviously a lot of market moving talks over the years that have come out of that economic forum. And so I think all eyes will be focused there to see whether or not the Fed starts its cutting cycle. But you get a hot inflation print, and all of that, all of those priced in cuts kind of get backed out of the market. So that can definitely create some noise in not only fixed income, but equities and currencies. The election, we knew that this was going to be a highly contentious race. We knew that there historically, when you look at the years of elections and the volatility profile of the markets, that vol just basically builds into the election and actually comes off pretty dramatically once we know who the winner is. And
Is that applied to? I know that it goes to implied volatility, but is that also true of realized volatility?
correct, realized volatility does grow kind of going into an election. And we've already had an assassination attempt, a candidate who we thought was running stepped down, a new candidate kind of forced into the seat. A split, if you will, amongst my friends in the Democratic Party that are don't know whether or not the process was right, or should there have been another primary. Is Kamala the candidate that they want? Who knows? But there will be, I'm sure, a lot of vol between now and then as markets react to not only polls but the overseas betting markets. And so, hey, buckle up, if you will. I think some larger issues that are just out there that could kind of come about. We talked about the regional banking crisis. That problem hasn't gone away. I mean, I saw recently that the average 35% from a work from home perspective on any average day. So work from home is not going away, which means that commercial real estate is struggling. The vacancy rate across the U.S. right now for CRE is 20%. Moody's said the other day that could get as high as 25% over the next year or two, as their leases are coming up in these office buildings in places like New York, where I am. And they just say, we had 4 floors in your building because of work from home. We only need 2. So we're still going to have office space, but we're giving you back some. That's putting a lot of pressure on that market, and the landlords, and then obviously the regional banks are the ones that are holding all of that debt. So that could be something that we could see, developing in the future. You got to think about cyber risks with what happened with CrowdStrike just 2 weeks ago. Obviously, what we're hearing is that it wasn't a hack; it was just a simple upgrade that went wrong. I am hearing there were a lot of hacks on the back of it as people rushed to try to implement fixes and basically got phished by the bad people who were putting out malicious malware to try to trick people into letting them into their systems. But just seeing the havoc that it caused, with 8.5 million users who had the CrowdStrike issue, bringing down in some cases, exchanges, banks, airlines. It shows you the dependency that we have not only as an economy but as a society on technology. And so, if there were to be some sort of major hack or outage, it's going to create huge issues across a landscape of different businesses. And then finally, I'll just say that there's a budget issue. It's been building for years. Obviously, we know that we have an issue in the United States where we continue to print money and spend at the government level without thinking about, at what point are we going to deal with all of the debt that we're incurring. It's not just the U.S.; it's happening across the globe, and so at some point that will have to be dealt with. And you can think that it will also at some point kind of bubble up to a point where markets don't like it, or God forbid a major G7 country gets close to a default. So I hate to be so negative, but you asked me the question, and I wanted to just kind of put out there what I'm hearing from investors, what people are worried about, and listen, once again, as we've talked about, our short-term trading strategy tends to do well when volatility is high. And so whether it's one of these catalysts, or as I like to always say, sometimes the market risk that really gets markets moving is the one no one is talking about, because it's not priced in, it's not being thought about. And so it's one of the benefits of being systematic, is that I don't have to, kind of extrapolate which of these risks we want to put a trade on for. Our models are simply waiting for those breakouts to happen so that we can trade the short-term momentum and hopefully add value to our clients.
Thank you, Michael. And yeah, on that commercial real estate point, it's funny. Like, a lot of the commercial real estate credit risk is within the regional banks. You're absolutely right, but it's also within the non-banks, CMBS market, insurance companies, publicly traded ETFs, but that trade the debt, like mortgage REITs. But like, it's like some regional banks have a ton of commercial real estate credit risk, and some have zero. But the stocks trade as if they're all the same thing, and it's so funny. Like, when interest rates go down, the market perceives that as good for regional banks, but there's like an individual regional bank that I know they want actually higher interest rates, but it goes down, and it's funny. Like, like on the fundamentals, Sunday on the intradays, fundamentals really don't matter, and that goes, the Stanley Druckenmiller quote. He said it 20 years ago, but it's probably truer now than it is than it was then. That he goes to these hedge fund dinners, and all the hedge fund managers talk about, oh, I like this stock, blah 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 blah, and he says like 50% of the move is, and I could be wrong with the numbers, 50% of the move is the market, and 30% of the move is the industry. So in this case, regional banks. And then he's being generous. That 20% was due to individuals, beta or alpha. But maybe it's less now. It's just so much is, not caring about the fundamentals.
Yeah, I think you're right, and it goes back to my earlier point that it's one of the reasons why I love working for a quantitative fund, where we build the models, we feed them with data, and it helps us to make our trading decisions. It's very, very difficult to sit around that room with smart people and try to predict what's going to happen, what's going to move, and as Wayne Gretzky used to say, you got to skate to where the puck's going, not to where it is. And it's hard. It's really, really difficult to make some of these calls and predictions. And so I've always been a believer in a systematic process. And the older I get, the more time I spend in the space, the more I realize that I'm thankful that I chose this as a career path.
Final question, Mike. Are you using AI in trading, and are you using it in a different way than you were 2 years ago, 5 years ago? Has your firm purchased NVIDIA chips, or are you using products that are employing advanced GPUs?
See, as I said earlier, we could not get through a podcast interview without mentioning the buzzword that is AI. In the quantitative hedge fund world, we joke a little bit about AI because we've been using as an industry machine learning techniques for 20 to 30 years. We were kind of some of the first folks in finance to play with things like regressions and using machine learning techniques. You're 100% right. They continue to evolve and get better over time. I think depending on what fund in the industry you talk to, there's a different level of from some people who are skeptical and don't want to use any AI to folks who I've heard about some recent launches of dedicated AI strategies that are 100% machine learning. And so there's a huge spectrum. I think we sit somewhere in the middle. As a quant fund, think about our process is you come up with an investment thesis, you find data to support it, you build a model, you run back tests, you make tweaks to it to the parameters you're choosing, and then you get approval and you put capital to it. Well, it sounds like using training AI to do that is not that difficult, but the problem that you have in our space, and technology aside, you always worry that a model is what we call curve fit, right? A curve fit is when somebody looks at what happened in the past and they build a model that looks incredibly profitable because they know what happened.
Yeah.
Um, that's curve fitting. Well, the fear that we have with AI is that it's a giant curve fit. When you train a model to kind of look at the data and say, go build me a great model, if it's looking at backward looking data, it might build a model that would have made a lot of money last year. But that doesn't necessarily mean it's going to make money this year. So I think we kind of try to put guardrails around our approach to AI. I mean, it's certainly way more scalable and efficient than a human being going out and doing research. So if you can set it on a problem and have it go out there and then create a nice little summary of all of the work that it's done to kind of help the humans, we think of kind of AI technology kind of working with human beings to make them more efficient as opposed to just doing the work for them, so to speak. And so there's plenty of examples kind of across our business where you can use AI to kind of look at the problem, run a million different iterations, and then give you some suggested kind of recommendations, if you will. And then the human can decide, okay, I want to pursue that path, or no, that doesn't look right to me. I want to do something else, as opposed to fully automating it and just letting kind of the AI kind of trade without some sort of human intervention or partnership. And I think that we're also seeing great advances in other parts of our business. We read hundreds of academic papers. That's what quant funds do. Using things like ChatGPT to create a summary means that you don't have to read the 180-page paper. You can create a one-page summary, and maybe you do that for 50 or 100 papers, and then you figure out which of those papers is relevant, and then you read the 180 pages, but of the paper that you really wanted to read, not the 10 that you read where you went, I didn't really learn that much, or this wasn't really relevant to my area of research. Looking for different data points when it comes to our performance and what's working and what's not to be able to communicate better to our investor base. We write a lot of code for our models, and using kind of Copilot and other tools that kind of help predict the next line of code, just like obviously we use the technology today to help predict how to write a better email or how to finish a text message. So there's tons of application. I think we are really just kind of starting to peel back the onion and see how it can be used across not only our industry but other parts of financial services. And I don't believe that it's just going to replace human beings. I think that, as I said, you think about it right now, my company is made up of doers and thinkers, and my goal is to have more thinkers than doers. So if I can use AI to do some of the brute force kind of work, then it frees up some of my people to actually be able to think more, if you will. And so I see a great relationship with AI technology going forward. And I do think that there's maybe a little too much euphoria right now, but that's what happens when regimes shift and people have that moment of realization that this technology is here to stay and that it's going to change the world.
AI does make stuff up. I've seen people, ask a large language model, like how many rocks should I eat per day to be healthy? And they say, well, actually, scientists said between 2 and 8 rocks, more than 8 rocks is unhealthy, but fewer than 2 rocks is also unhealthy. So you want to eat 2 to 8 rocks. So if you word it in a certain way, it's a people pleaser. And if you ask a question, find me a strategy that makes 100% a year with a Sharpe ratio of 20, the risk is it might pretend to actually have that strategy when it doesn't, and it's a huge tail risk. Michael, this has been fascinating conversation. Thank you so much for sharing your time and insights, and thank you everyone for watching.
Jack, thanks so much for having me.